Are you drowning in debt and wondering whether a personal loan or a credit card is the better way to pay it off? The choice you make can save you thousands in interest or trap you in a cycle of escalating debt. If you've been struggling with credit card debt or considering debt consolidation, you need to watch this video all the way through. We'll break down the true costs, the effect on your credit score, and which option actually helps you regain control of your finances. By the end, you'll know exactly which path can lead you towards smarter financial planning and help you finally pay off your debt faster. Let's start by defining these two borrowing methods. A personal loan gives you a lump sum of money up front with fixed monthly payments and a set term for repayment, usually between 2 and 7 years. Credit cards, on the other hand, offer a revolving line of credit, letting you borrow repeatedly up to a certain limit. You repay based on how much you owe each month, with flexibility to pay the minimum, the full balance, or anything in between. But that flexibility comes at a cost. While personal loans often have a fixed annual percentage rate, or APR, typically ranging from about 6% to 36%. Credit card interest rates are much higher on average, sitting around 24.7%, and can vary widely depending on your creditworthiness. This difference in interest rates can make a huge impact when paying off debt. Consider this. If you had $10,000 of credit card debt with an annual percentage rate of 24%, making only minimum payments could take over 20 years to pay off and cost you more than twice the original amount in interest alone. Contrast that with a personal loan at 10% APR, repaid over 5 years. The loan would be fully paid off in a much shorter time, with significantly less interest paid overall. This is why many people turn to personal loans for debt consolidation, rolling high-interest credit card debt into a single, lower-rate loan with predictable monthly payments. Credit cards do offer some benefits. You can use them for everyday purchases, earn rewards, and if you pay your balance in full each month, you avoid interest charges entirely. However, if you carry a balance, credit card debt can quickly escalate due to variable and often high interest rates, late fees, and other charges like cash advance and over-limit fees that personal loans usually don't have. This makes credit cards less suitable for large, ongoing debt balances. Another important factor is your credit score. Both personal loans and credit cards affect your credit, but differently. Taking out a personal loan adds a fixed installment loan to your credit mix, which can be beneficial if managed well. However, applying for a loan or a new credit card hard checks your credit report, which may cause a temporary dip. On the flip side, consistently carrying high credit card balances can harm your credit utilization ratio and lower your score. Using a personal loan to pay off credit card debt can improve your credit score over time if payments are made on schedule. Personal loans usually come with some fees, like origination or establishment fees, and possibly prepayment penalties. But their fixed interest rates and repayment schedules provide stability in your financial planning. Credit cards, while more flexible, often charge annual fees, late payment fees, and variable interest rates that can rise without warning. This unpredictability can make budgeting and long-term debt pay off harder. Let's illustrate with two scenarios. In the first, you have $10,000 debt on your credit card with an average APR of 25%. If you make minimum payments, it could take over 20 years to pay off, accruing nearly $15,000 in interest. In the second, you take out a personal loan for $10,000 at 12% APR to pay off the card balance. You commit to a 3-year term, paying roughly $333 per month. After those 3 years, your debt is gone, and you've paid about $1,200 in interest, far less than the credit card scenario. That's the power of choosing the right debt payoff tool. In short, personal loans usually offer lower, fixed interest rates and predictable payments, making them a smarter choice for paying off large credit card debt quickly and protecting your credit score. Credit cards are better for small purchases if you pay the full balance each month to avoid high interest. To get out of debt faster and save money, consider a personal loan with a good APR and stick to a repayment plan. This way, you take control of your debt and move toward financial freedom.